Okay, so good morning. Let's get a quick briefing in here. Emphasis on the word quick. Because, well, I guess, welcome to the summer lull.
Going back to this move in the FX market.
It's arrived a little bit late, perhaps, this year, but here we are nonetheless. Yesterday's session, notably absent of any news flow of any significance. So we're kind of just drifting a little bit. Now, just before I get going, just be aware of the euro dollar, which has just popped higher, as Rand's been saying. So just breaking up through the pivot level. This has been a key barrier right the way through the Asian session last night. Just ticking up through that. Perhaps some stops in there getting triggered. We're just testing the low point from the 16th of July last week, which we slid through in the back end of Friday's session, but perhaps still a price point of note. Of course, I think yesterday's high, probably a better level. That's up at 108.78, and maybe let's just have a review of this market, looking at the longer term, because look at what's happened over the last 3 days. Friday, Monday, now today. If you ever wanted evidence, if you ever need evidence that the ability to perform just basic technical analysis is a very useful skill in trying to predict how markets might behave, where they might find price points where they're going to change direction at, and so on. Well, check out the last 3 sessions, bang on this May low. So 108.20 is the key price point, and we got a low for the year, but it's just set back mid-March, of course. I'm just going to put a fib series on the range of the year, actually. And where we are, we're trading around about the 61.8 fib level. But yeah, you got to understand that the low point, 108.20, is massive. If that breaks, and obviously we're on the up here and making new highs for the session, but if this does give way, as we expect it to, then really this opens the door for a continuation of, well, what's been, I guess, a month-long phase to the downside anyway. It's been a particularly tricky few months for this currency pair, given the nature of the difference in the nature of the influencing factors on this. Of course, you've got the euro and the dollar in here, and perhaps the euro's been more dominant in influencing how this currency pair has been behaving. Just in the last month, particularly with the Greek crisis, failing to really feed through into any kind of euro weakness. But there's many reasons for that, which we've discussed at length. Things like short covering, that's exchange rate hedges, that's international investors exiting European equity investments, and once they've taken those investments off because of the perceived risk of the Greek default, well, they don't need their exchange rate hedge anymore. And so a lot of this has been short covering, although that kind of phase is done, and indeed, of course, we don't have a Greek exit. So you could actually say, well, if investors are going to wade back into, and I mean international investors are going to wade back into the European equity space, well, aren't they going to need their exchange rate hedges back on again, in which case that's downside pressure. That is shorting euro dollar to hedge yourself against the valuation of the euro declining, undermining the value of your portfolio, which is partly denominated in euros. So I think perhaps, and it's some of these assets, it's quite difficult to pick direction now in the medium term. Now that we've kind of just found a bit of a lull, Greece paid their bill yesterday. We are up and running with regards to Greece paying bills and actually getting new money, getting new funding. Of course, it's only temporary. It's a bridge for the next couple of months. But nonetheless, the default's off the table for that couple of months. Okay, so that's gone. Chinese equities have been, well, flat, I guess. They bounced a little bit and they've been flat now for a week and more. And these two risks are just subsiding. And so it's quite difficult to pick medium-term direction, but we'll come and look at some of these other assets in a minute. But for the euro dollar, we would expect this downside to continue. I think one of the easier calls is euro dollar to trend to the year low. So this is down around the 105 handle, of course. Two key bottoms, the April low at 105.29 and the March low at 104.74. This is on a continuation chart. But do not forget about 108.20. This is the key level before basically we get to the low of the year. So for the last 3 sessions, and of course this one's only just got up and running, but for the last 3 sessions this has been a key barrier to the downside. Okay, that's enough about the euro dollar. Let's have a look at the S&P yesterday, because the S&P is flirting with its all-time highs, of course. And yesterday we finally did drift up and break the June the 22nd high at 21.22. We were talking a lot about this price point through yesterday's session. The problem, well, not the problem, but the interesting factor was that actually come the close last night, this market had pulled back and we closed right on the level. So it kind of makes that break, well, it's only an intraday break rather than a close break. So we're trading right on that now still. So 21.22 on the longer term chart that we're looking at here is still an important price point. Of course, the high of the year, well, where did we trade to? What was the high from yesterday? Well, it was the September contract all-time high. So I mentioned this price point yesterday as well. 21.26.25. That was the top, and that's because it was the September contract high back in May. Now the all-time high, looking at the continuation chart here, is 21.34. So perhaps there is scope for that price point to be reached. It will depend on the earnings this week. In the main part, perhaps it will depend on what Apple deliver when they announce their earnings after the close. Also Microsoft with earnings after the close tonight. IBM reported last night and kind of bucked the trend a little bit. We've had generally a reasonable start to the earnings season, but IBM delivered some disappointing numbers. Their share price dropped 5% in aftermarket trade, and quite phenomenally they've had revenue decline for 13 quarters in a row, which is impressive in how bad that is. 13 quarters straight of revenue decline. Of course, IBM's perhaps a sort of classic example of how the IT space has evolved, and how a company that was fully geared towards the old version of the IT space is suffering. They're trying to reshape, they're trying to change direction, they're trying to invest in things like the cloud, diversifying themselves away from their old traditional kind of just physical servers, which of course are becoming more and more obsolete. But still, 13 quarters in a row of declining revenue, that is impressive in how bad that is. So 5% drop in their share price last night. But we'll see Apple and Microsoft delivering, but not until after the close tonight. Okay, there has been some concerns about Apple's iWatch. That'll be the most interesting thing, perhaps, because we'll get pretty much a full quarter's worth of iWatch data, which we've never had before. Obviously, the iWatch became available right at the end of quarter one. So really, this will be the first test. How many units did they sell? And maybe the first quarter this product is on the market is not the best one to analyse, because you're always going to get the die-hard Apple addicts buying whatever Apple produce. They don't really care what it does or what the rate or what the analysts say about in terms of the quality and whatever. They're just going to buy it. So maybe these quarter one figures aren't going to be representative of the medium to long-term trends, but there has been a little bit of muttering that this iWatch isn't quite all it's cracked up to be. So it'll be interesting to get the first set of numbers on this. So this will be tonight. Let's just look at the short term, because actually yesterday we did trade up. It didn't quite happen The intraday high yesterday was, well, actually on the cash market. This is the futures we're looking at here, of course, but the cash market, the S&P 500 cash market, actually did trade up above the all-time closing high, just on an intraday basis. But still, look, we're right up at the top of the range, and earnings coming through this week will probably determine whether this top stays in place or whether we can actually go up and break it. Let's just quickly look on the 1 hour time frame. Just let this load up. So, sorry, this needs a bit of adjustment in terms of the levels and things. But yeah, you saw what happened yesterday. The 21.22 barrier held firm for most of the day. After the European close, we managed to push up and hit that September contract high, and then we pulled back and things just settled down. Now this morning we're trading within that range, very quiet, very little news flow to report on, and unfortunately no economic data today, and actually no earnings either until after the close tonight. So do bear that in mind. It's likely to be a fairly slow session, like it was for a lot of the day yesterday. Now I think European equities are looking a little more vulnerable perhaps. The DAX has been down to test yesterday afternoon's low. It's S1 today. It held firm to start with, so let's see. We've got a bit of a gap fill here between yesterday's low and sort of Friday's close. So we'll see. Things are drifting a little bit. Let's look at the Bund. Technically also quite neat and in the opposite way in many respects to that DAX, in that we've traded up to test yesterday's high. So the Bund has traded yesterday's high, 153.33. This is R1. It's almost like the flip mirror image of that DAX. And a test, a hold, and a little drift lower. But, you know, you've certainly got a decent trend on the go here for the Bund out over the last week. So volumes are low. Let's see if these technical levels can get breached or not. Oil, keep your eye on oil because this is a very important one as well. We've got a triple bottom here. $50.14 was last week's low. It was yesterday's low last night into the close. It's also this morning's low, $50.14. We haven't traded below $50 for 3 months. I'm going to show you on a daily chart. We have traded below. We're obviously making new lows for the month here. This triple bottom is below that 7th of July low. And of course this is definitely looking technically negative. You would certainly say that, and I guess there's no reason we can't drift lower. We've got some dollar strength in the mix, and of course, thinking about commodities more generally, gold has been. I mean, it's a surefire sign of nothing's happening in terms of macro fundamentals. I kind of got the FT app open this morning, and about 5 of the 10 articles in the markets section were about the same thing, about gold. So it does just go to show there is nothing much going on and nothing to kind of get your teeth stuck into. But look, the commodity space is under heavy pressure. In fact, quite extraordinary. The commodity indexes out there are trading down almost at 2002 lows, which is pretty incredible. But here's an update on gold. Quite an interesting chart on the FT. One of these 5 articles that were phenomenally repetitive. But here was one chart, just looking at the long term, and just a nice reminder, Gordon Brown's bottom, if you ever want to be reminded of Gordon Brown's bottom, but this is the 1999 low, and that's like a 40-year low. That's where Gordon Brown decided it would be a good idea for the UK to sell about 50% of our gold reserves. So I'm still yet to find anybody who can find me a worse trade. This, as far as I read it, is the worst trade in history. Selling half of our gold reserves at the 40-year low. Anyway, that's where you take the fib level from. And if you draw a fib level to the all-time high set in 2011, well then, here we are back at the 50%. So 1,086, 50% fib level of this mega uptrend, and of course the $1,000 print is key from a psychological point of view. So, gold under a lot of pressure here. Now, it's pretty interesting. I guess, how did gold get up to these almost just shy of $2,000 back in 2011? And when you think back, the positive influencing factors for the gold price, were remarkable. They all lined up. It was the easiest trade, I would say. Like buying gold at the start of 2011 or even 2010 and holding it was got to be one of the easiest trades of the last decade, because all the stars aligned. You had a Eurozone debt crisis which threatened to annihilate the monetary union. You had also, in the summer of 2011, a very real risk of the US defaulting because of political deadlock in Washington. You also had high inflation in Asia and in Europe. Then on top of that, you had quantitative easing and zero interest rates, which is phenomenally inflationary anyway. And you had a weak dollar. It was all the stars aligned, and gold just went through the roof, of course. Now, of all those things that drove gold higher in 2011, you've kind of got the reverse. Yes, okay, we've had some Eurozone risk, but of course it's nothing like, a Brexit is not the risk it was. It's nowhere near the risk it was. Look how remarkably resilient the rest of the Eurozone asset prices have been to the Greek risk this time round. So, the chances of the Eurozone breaking up are, well, certainly in the next, I don't know, let's put a figure on it, in the next 5 years is now almost back to zero. Inflation is the lowest it's been ever on record. Globally, pretty much. All right, there's pockets of inflation in countries like Brazil and Russia and so on, but generally, all-time ever low inflation. So that's clearly a very big negative. The Fed has stopped quantitative easing. They're about to start hiking rates. Okay, you could say that we've got the Bank of Japan and the ECB printing at full steam, but now we know quantitative easing isn't inflationary in this day and age. This is something that completely confounded economic analysts back in 2011. Very critical analysts saying, look, if the Fed carry on printing, we're going to get hyperinflation and it's going to blow up the whole planet. Well, they were exactly wrong. Not only did we not get higher inflation actually moved lower. So we're not worried about inflationary pressures from quantitative easing anymore. So we're left with a record low inflation environment. And then, of course, there's the dollar. The dollar's getting stronger. That's a negative, of course. And we've got China at their weakest point, well, who knows for how long? Decades. And so you've got a commodity sort of complex that's been savaged as a result and is down at 13-year lows. So, you had everything lining up in 2011 saying this price should go higher, and it's actually pretty much everything lining up in 2015 saying this price should go lower. So I'm not buying. Yes, we're at the 50% fib. Yes, we're at the 1,000 handle, but I think it's too early to buy. I think this is a buying opportunity, but later in the year, I want to see the inflation trends properly turn before this looks attractive. So, and whilst we still have China risk, that's definitely going to keep the commodity complex under pressure. As long as we still have Fed rate hike risk, well, that's going to keep the dollar pushing higher, and these things should keep gold under pressure. Okay, so this will be a good buying opportunity. It's just not yet. That's my opinion. All right, so let's crack on with the day, with the session. You've got to really get your mindset right. There were a couple of good trades on yesterday. The S&P one particularly. The Amplify strategy nailed it with a long around the 2117 area, and then target back at the 2122 level. Now that trade took a few hours to execute, but it took a few hours to actually get the opportunity in the first place. So get your mindset right, select some levels that are good ones, and then you've got to be prepared to wait. Don't get led down the boredom trade path where, look, you've waited so long for a level, sod it, it's not going to get there, I'm just going to take a price point that's not as good. That's the error in trading these kind of slow markets. You've got to be patient on the way in, patient to wait for your entry point, and then you've got to be very patient on the way out. So get your mindsets right. But we might get some decent movement. Let's say 108.20 breaks on euro dollar. Let's say $50 breaks on crude oil. You know, these are very important price points that could trigger some decent sort of technical extensions. Good. Right, that's it from me. Enjoy the session, guys. Thanks.